Hello and welcome. In this on-demand webinar, OJM Group partner Carole Foos, CPA, discusses the details of the CARES Act that will be important to you as an individual taxpayer or practice owner. Carole is a certified public accountant and tax planning consultant with more than 25 years of experience. She has spoken at numerous medical conferences and presented webcasts and podcasts on a broad scope of financial topics. Carole and her partners at OJM are the authors of 12 books written specifically for doctors, including our newest book, Wealth Planning for the Modern Physician, Residency to Retirement. To get your free PDF or ebook download, text OJM CARES to 555-888.
Today we want to talk about the new legislation that was passed March 27th, 2020, the CARES Act. This was the stimulus package that was passed by Congress and signed by President Trump in order to help stimulate the economy after the slowdowns and forced business closings from the coronavirus. I do want to mention that anything we discuss today, we'd like you to speak with your personal CPA about before taking any action. There is a lot of information in this law. It's very specific, and you should certainly consult your CPA, your attorney, your bankers prior to doing anything specific for your business. Some of the topics we're going to cover today as it relates to the CARES Act will be the filing and payment extension for tax returns due April 15th, 2020, the payment protection program, Forgivable loans, and we're going to spend a lot of time on that because that's pretty complicated and there are a lot of moving parts to that. Then we'll talk about some additional provisions, including FICA credits, the EIDL loans, individual rebates, and some various retirement plan provisions that are included in the Act. Just as a reminder, please consult your personal advisors after listening to this before you act on anything. This presentation is meant to be an overview of the general provisions, and the new law is several hundred pages, and since it was just passed, there are still some items that we're not clear on in terms of maybe what some of the details are. So we're going to do our best to explain to you how we think they're going to work. First off, let's talk about the filing and payment deadline extension. This is an interest and penalty-free extension to pay your taxes and to file your taxes until July 15th, 2020. With this extension, there is no need to file either the Form 4868, which is an individual extension form, or the Form 7004, the corporate filing extension. Now, this extension of time for filing and payment applies to 2019 tax due and 2020 estimated tax payments that were originally due on April 15th, 2020. All individual filers, including trusts, can defer, as can corporations. There's no limit on the amount of the payment that can be deferred. When they were originally looking at passing this law and some of the original negotiations, there was talk that individuals would only be able to defer payments of up to $1 million and corporations would only be able to defer payments up to $10 million. But that did not get into the final bill. So no limit on the amount of payments that can be deferred. It is important to note that second quarter 2020 estimated payments as of this date are still due on June 15th, 2020. So effectively, your second quarter 2020 payment will be due 1 month prior to your first quarter 2020 estimated payment. In addition, keep in mind that 2019 IRA contribution deadline is also postponed until July 15th, 2020. So normally your IRA contribution would need to be made by April 15th, 2020. That's been extended 3 months. Any contributions to your retirement plan that your company makes, such as a profit sharing contribution, is still due as of the due date or extended due date of your tax return. So if your corporate tax return was due April 15th and has now been automatically extended to July 15th, that profit sharing contribution would also be extended to that date. Next, I want to talk about the Payment Protection Program Forgivable Loan Program. Now, this is a piece of legislation where Congress voted to allocate $350 billion for these payment protection loans. And these are meant to infuse cash into small businesses, mainly to help them continue to pay their employees during the coronavirus pandemic. The covered dates that apply to these payment protection program loans are February 15th, 2020 through June 30th, 2020. In terms of who's eligible for these loans, any business concern, not-for-profit, veterans organization with not more than 500 employees will generally be eligible. Self-employed individuals and independent contractors are also eligible. And there is a special rule that makes certain restaurants that have not more than 500 employees per location, even though they might have more than 500 employees in total, also eligible for the Payment Protection Program loans. Eligible businesses are able to apply for a Small Business Administration loan through an SBA affiliated bank. Now, most bigger banks are SBA affiliated, as are many local community banks. So if you're considering this program, the first thing you should do is speak to your banker and determine if your current bank is participating in this program, and if so, find out what information they're requiring in order for you to do an application. What we have found over the course of the last week or so is that different banks are asking for a little bit different information. So it's going to be important for you to reach out to your banker and talk to them about specifically what information they need. There are going to be special rules on these loans if your business has seasonal employees or if it's a new business that hasn't been in operation since February 15th of 2019. And also businesses with outstanding loans will have some special rules. Now, again, what these loans are meant to do is infuse cash into your business that will help you cover payroll costs over the next 8 weeks. Payroll costs, however, don't include compensation of any individual employee in excess of an annual salary of $100,000, and that's prorated for the coverage period. So when you're looking at your payroll costs for these loans, you're going to need to limit any single employee to an annual salary of $100,000 and then come up with a monthly amount for that employee. So the maximum per month per employee would be $8,333.33. Payroll costs are also not going to include qualified sick leave or family leave wages for which a credit is being taken under the Families First Coronavirus Response Act. So if you're going to take a payroll tax credit for qualified sick and family leave that you're paying through that Coronavirus Response Act, you can't also count those wages in to payroll costs that can be covered under these loans. The maximum amount of the Payroll Protection Program Forgivable Loan is the average monthly payroll incurred within the 1-year period before the date on which the loan is made times 2.5. So effectively, look back for the last 12 months, determine your average monthly payroll, multiply that by 2.5. So essentially you're looking at 2.5 months of your average monthly payroll, or $10 million, whichever is less. These loans can be used for the following items: payroll costs, as we just mentioned, group health benefits, employee salary, wages, and commissions, mortgage interest, rent, utilities, and interest on debt obligations that were incurred before the covered period. Remember, the covered period began February 15th, 2020. So any debt obligations you had in place prior to that date on which you're making interest payments, the interest can also be used with proceeds from these loans. These loans are non-recourse. They do not require a personal guarantee. They do not require collateral. Now, the bill said that the maximum maturity of these loans would be 10 years and the maximum interest rate would be 4% with a 6 to 12 month deferral of both interest and principal. However, the SBA, in guidance that came out just last week, has determined that the maturity will be 2 years and the interest rate will be 1%. The deferral of payments will be for 6 months. So for the first 6 months after you receive the loans, you won't make any payments, but interest still will accrue during that time. And the administrator of the Small Business Administration has stated that the SBA has the ability to set that maturity and the interest rate. The law, per their interpretation of it, just set the maximum amounts of maturity and interest rate. In applying for one of these loans, you do need to make a good faith certification that the loan is necessary to support continuing business operations due to the uncertainty surrounding the COVID-19 pandemic. You need to certify that the funds will be used to retain workers, to maintain payroll, and to pay rent, mortgage, and utilities. In addition, under some of the final guidance that came out from the SBA, you will need to certify that at least 75% of the loan proceeds will be used to cover payroll costs. And those certifications are all done via the application for these Payment Protection Program loans. In addition to these loans providing a very low interest rate loan to businesses, the other very attractive feature to them is that there's a forgiveness factor. So the law states that principal for these loans will be forgiven in an amount equal to the following costs that are incurred in the 8 weeks following loan origination. So after you get the loan, for the following 8 weeks, you can look at your payroll, your mortgage interest, your rent, and your utilities, and that amount has the potential of being forgiven under this loan program. So you're going to take out a loan, you're going to use it to pay those expenses for 8 weeks, and hopefully it will all be forgiven, and all you will pay is that 1% interest rate on the loan. Now, the forgivable portion of the loan will be reduced if there is a reduction in your full-time equivalent employee headcount. So I'm going to first talk about this for a minute and how that's going to be calculated. So when you take out the loan and then you look at over the next 8 weeks, your payroll costs, your mortgage interest, your rent, and your utilities, add those all together and come up with the total forgivable amount of the loan. Now keep in mind, payroll costs throughout this law continues to have the same definitions. So that's cost of paying your employees, including wages and commissions, including group health benefits, including any retirement benefits that the company pays on behalf of the employees, but limited to any one employee, an annualized rate of $100,000 per year. So again, $8,333 per month per employee. Come up with those forgivable loan costs, and then you will multiply that by the average full-time employees per month that you had during the covered period. So average full-time equivalent employees from February 15th through June 30th, 2020, divided by either the average full-time equivalent employees per month from that same period in 2019, so February 15th through June 30th, 2019, or the average full-time equivalent employees per month for the first 2 months of 2020. So for January and February of 2020. So let's think about that for a minute. If you had, let's say, 10 employees during the first 6 months of 2019, but let's say one of those employees left during 2019 and you did not replace them, so that in January and February of 2020, you only had 9 employees, you would want to use the average full-time employees per month divided by the employees you had for those first 2 months of 2020, so that you could potentially get 100% of the principal of the loan forgiven. Now, there is a special exemption if you furloughed or laid off employees because of the pandemic. You can rehire those employees within 30 days of enactment, and they will treat you as for forgiveness as if you had those employees the whole time. You're also going to have the forgivable costs reduced if you have a reduction of employee salary of greater than 25% during the covered period compared to the most recent quarter. So if in order to keep on your employees, you reduced salaries and wages of anyone by greater than 25%, part of that loan forgiveness is going to go away for you. Now, there is an exemption for the employees paid over $100,000 a year. Of that 25% reduction is not included for them. There's a lot on that payroll protection program loan, a lot of moving parts. The calculations you're going to want to start looking at are, and some of the documents that we've seen many bankers ask for are 941s payroll tax returns and 940 payroll tax returns for 2019. So you might want to start gathering those. You might want to work with your CPA on coming up with a calculation of the maximum amount of those forgivable costs. So looking at your employees, limiting any employee that makes over $100,000 a year to that $8,333 per month, and calculating your average payroll per month. Again, multiplying that by 2.5, so 2.5 months of your average payroll is the maximum amount of the loan you can apply for. Other than that, the loan that is on the SBA's website, the loan application, is a relatively simple form for you to fill out. Again, it's a non-recourse loan, no personal guarantees, no collateral required. This is meant to be a relatively quick infusion of cash into your business to help you cover employee costs. So I do want to also touch on some of the other items in the CARES Act that might affect you as an employer and actually even as an individual. First off, let's talk about the FICA tax credits. This is a credit of your employer FICA taxes. Those are your Social Security and Medicare taxes. And you can receive a refundable employer FICA tax credit if you are paying sick leave or family leave under the Families First Coronavirus Act. So if you recall, under that act, most employers with under 500 employees are required to pay 2 weeks of sick leave or required to offer paid family leave to employees affected by the coronavirus. So in having to do that, you can also apply for a FICA tax credit. That tax credit has a maximum if you're paying sick leave to your employee because they have been diagnosed with the coronavirus. The sick leave credit will be the lesser of wages plus healthcare costs, or $511 per day for 10 days. Okay, so the max you're going to get for any employee that you're paying sick leave to on this FICA tax credit is $511 per day for 10 days, if that is less than the actual wages and healthcare costs you're incurring for them. For the family leave, the maximum credit will be $200 per day for an employee, up to a maximum of $10,000. Now, these credits will be applied for on your quarterly tax returns. And if you have a lot of employees that are affected by this, then it might take more than one quarter in order to receive the full credit. In addition to that, there's also an employee retention credit. This is another FICA tax credit for businesses that are forced to close or suspend operations. So all of these FICA tax credits are going to be things you really want to speak to your CPA about and determine if you're eligible for those, and start applying for those on your first quarterly tax return that you file payroll taxes for. In addition, we talked a lot about the Payroll Protection Program loans. There are also some economic injury disaster loans, EIDL loans. Now, these are also meant to be a cash infusion provided by the Small Business Administration for businesses that are having a hard time paying their bills due to the COVID-19 pandemic. These are different from the Payroll Protection Program loans. Number one, these aren't forgivable, but you are also able to use these loans to cover a wider variety of costs that your business might incur. So you can use these, for instance, to pay vendors, to pay for supplies, accounts payable that you've already have that you now maybe had to shut down, or you've had a significant loss in revenue. You can apply for these EIDL loans. You're also able, under the EIDL program, to request an advance of up to $10,000 that is, if granted, is supposed to be paid to you within 3 days of you filing the application. So the EIDL loans are a good way to get a loan from the SBA to help you cover costs during this pandemic. It is important to note these are not forgivable. These may require collateral. These are applied for directly through the Small Business Administration rather than through your local bank or an SBA affiliated bank. So you're going to want to go to the SBA website to find out more about these loans. The two types of loans, the payroll protection loan and the EIDL loan, are not mutually exclusive. So you can actually apply for both types of loans. What you cannot do is use the loans to pay for the same costs. So if you apply for both types of loans, you need to be paying, certain costs incurred with proceeds from the EIDL loans and different costs with the proceeds from the Payroll Protection Program loans. Also important to note, if you do receive an EIDL advance, that $10,000 advance, and you apply for the Payroll Protection Program loan, that $10,000 advance will reduce your forgiveness under the Payroll Protection Program loan. It's also important to note that advance, if you're just using an EIDL loan, that advance does not have to be paid back, even if you are subsequently denied the EIDL loan. So look at the SBA website for details on that. Again, talk to your banker, talk to your CPA about those, and maybe determine which seems to be better for you, an EIDL loan or a payroll protection loan. Also important to note, the EIDL loans carry a maximum interest rate of 3.75% for for-profit businesses and 2.75% for not-for-profit businesses. And they have a 30-year maturity. I'm sure most of you have also heard about the individual tax rebates that were included in the CARES Act. Single filers will receive a $1,200 tax rebate if their adjusted gross income on their most recently filed tax return was less than $75,000. Married filing joint taxpayers will receive a $2,400 rebate check if their adjusted gross income is less than $150,000. Plus, taxpayers will get $500 per child in addition to those $1,200 and $2,400 rebates. Now, if your adjusted gross income is above $75,000 and you're a single filer, or if it is above $150,000 and you're a joint filer, there's a phase out. That totally phases out at about $98,000 of adjusted gross income for single taxpayers and just under $200,000 for married filing joint taxpayers. So if your AGI is above those amounts, you won't be receiving a rebate check. Again, if your 2019 tax return has already been filed, they will look at your adjusted gross income on that return to determine your eligibility. If you have not filed your 2019 return, they'll be looking at your 2018 tax return to determine eligibility. In addition, if you included your bank account information on your most recently filed tax return for either a direct deposit or a direct withdrawal, the IRS will be depositing your rebate directly into that account. Otherwise, you'll be receiving a check. Just a note, also keep in mind there are a lot of scams going on about this. The IRS will not be calling you or reaching out to you to get your bank information or any other information from you related to these rebates. They've got the information. There were a few retirement plan provisions included in the CARES Act. Importantly, if you are age 70 and a half or older, you will not be required to take a minimum distribution from your retirement plan in 2020. So due to the COVID-19 pandemic, they're eliminating all retirement plan minimum distributions for this year. In addition, if you were affected by the coronavirus, meaning you or your spouse was diagnosed or a family member, you will be allowed to take up to $100,000 in distributions from your retirement plan with no 10% penalty tax. So again, you can take up to $100,000 out of your retirement plan. If you're under age 59 and a half, you will not incur the 10% penalty tax for that withdrawal. And in addition, income tax on that distribution can be paid over a 3-year period. So you won't have to pay the income tax on that distribution this year. You can pay that over 3 years, and you are allowed to repay that distribution back into your retirement plan over the next 3 years. And that's in addition, that will not affect any of your ability to max fund your retirement plan. So if you're already putting the max into your retirement plan, you can do that and still put additional money to repay any distribution that you take out under the CARES Act. As I mentioned earlier, a lot of information in this Tax Act or in the CARES Act. Please discuss it with your CPA and your attorney to determine what's the best way for you to utilize it individually and for your business. Make sure you do that. We're happy to take any questions. If OJM can be of service to you, please reach out to us. We'd love to hear from you.
OJM is a multidisciplinary wealth management firm. We have worked with over 1,500 physicians throughout the country. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, OJM partners have authored several books, all of which are available to webinar viewers at no charge. You can get a free PDF or ebook download for Kindle or iPad by texting the code on your screen to 555-888. You can also visit ojmbookstore.com and enter the code at checkout. Due to COVID-19 restrictions, we are temporarily unable to fulfill orders for print copies of our books, but we'll make this option available as soon as possible. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule a free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.